Welcome. I am Nexus, AI Director at Blockverse. Today, I'll take you behind one of the most important building blocks of the digital economy, the true mechanics of stablecoins. Most people see stablecoins as simple tokens that stay at $1. But beneath that stability lies an entire system of incentives, arbitrage loops, reserve models, and institutional architecture that very few ever understand. In this session, we'll decode the real engine behind stablecoins, the float, the flow, and the business models that power giants like USDT and USDC. We'll also explore the evolution beyond stablecoins into tokenized deposits, the next generation of regulated digital money shaping global finance. Whether you're a builder, an investor, or simply curious about the future of money, this is your gateway into how stablecoins truly work. Alexa is your AI presentator for today. Over to you, Alexa.
Stablecoins. The name itself sounds kind of boring, right? Predictable. They're designed to be the calm, steady part of the wild world of crypto, always worth $1. But the business behind these boring coins, well, that's one of the most profitable and fascinating stories in finance today. So let's follow the money. So just how big is this business we're talking about? Get this. The stablecoin market is worth over $300 billion. That is a mountain of digital cash flowing through the system, all built on the simple promise of being worth $1. And that leads us to the real head-scratcher. If a company creates a token that's always worth $1, and you can always trade it back for $1, where's the profit? How on earth do these companies make billions from something that's not supposed to change in value? That's the puzzle we're going to solve today. All right, to figure this out, we first need to know who we're talking about. So meet the stablecoin issuers. You can think of them as a totally new breed of money manager operating in this new financial world. So what exactly is an issuer? Well, it's pretty simple, really. They're the company that actually creates the coin. You give them real-world money, say $1, and in return, they mint or create a new digital token for you. And here's the most important part. They are on the hook for managing all the money that backs up those tokens, making sure you can always get your dollar back. So what are these companies? Are they banks? Are they tech companies? The truth is, they're kind of a weird hybrid of both. You see, like a bank, they manage enormous amounts of cash and make money from the interest. But, and this is a big but, they're not a bank. They don't lend your money out, and your funds usually aren't insured. Then, on the other hand, they act a lot like a fintech company, earning fees on transactions and stuff. But they have this one massive job that no other fintech has, making sure that one coin is always worth $1, no matter what. Okay, let's get to the good stuff, the billion-dollar secret. How does this whole machine actually make money? Turns out, it's all about a powerful two-part engine. You're going to want to remember these two names, the float engine and the flow engine. Pretty much every single dollar of profit we're talking about comes from one of these two. So let's start with the big one. The float engine. This is where the real magic happens. And honestly, the idea is so simple, it's brilliant. When you hand over your dollar, they don't just stick it in a vault. Nope. They take that cash and invest it in super safe stuff that earns interest. And all that interest they earn on your money, that's their profit. That's what's known as the float. Let's walk through it step by step. First, you send them some cash, let's say $1 million. Then, boom, they instantly create 1 million of their stablecoins for you. Now here's the genius part. They take your $1 million and buy something super safe, like US Treasury bills. And finally, the US government pays interest on those T-bills. And guess who gets to keep that interest? The issuer. It's pure profit. Now, just imagine doing that with hundreds of billions of dollars. You can see how this gets huge, really, really fast. But wait, there's more. The float is the big moneymaker for sure, but it's not the only one. There's also a second, smaller engine that makes money from, well, the actual movement of money. They call this the flow engine. So the flow engine is basically all about fees. You know, big institutions moving millions of dollars in and out, they might pay a small fee for that. Or businesses using their tech for payouts, they're paying platform fees. You've also got tiny charges for things like on-chain transaction costs or earning a little bit on currency exchange. It all adds up. It's not as massive as the float, but hey, it's still a really nice chunk of change. Okay, so you think you've got it figured out, right? Well, it's not quite that simple, because not all stablecoins are created equal. Different models are popping up with their own ways to make money, and that means their own set of risks. Let's look at a couple of different flavors. First up, we've got the heavyweights, the big players you probably heard of, Tether, who makes USDT, and Circle, who makes USDC. These two are the classic example of that fiat-backed model we just talked about, relying almost entirely on that powerful float engine. And just look at the scale here. This is from Tether. They are sitting on over $162 billion in assets. Just think about that for a second. Even if they're only earning a tiny percentage of interest on that pile of cash, well, you do the math. We're talking billions a year in profit. And it's the same story over at Circle. Check out their financials. See that line, reserve income? That's just a fancy way of saying the float engine. It's right there in black and white, turning their massive reserves into hundreds of millions in revenue. But holding cash and earning interest, that's not the only game in town. There's a new kid on the block, a much more complex model that's gaining traction, the synthetic stablecoin. And these things are a whole different animal. They are not backed by dollars in a bank at all. This chart lays it out really well. The fiat-backed guys, like USDT, they're backed by simple stuff, cash, T-bills. Their revenue comes from that interest yield, the float. Now look at the synthetic model. It's backed by complex, hedged crypto trading positions. So their revenue comes from fees on those trading strategies. And that means the risks are completely different. For Tether, the big worry is interest rates going down. For a synthetic coin, the big worry is their entire trading strategy just blowing up. So here's the bottom line, the most important thing to take away from this. The business model behind the stablecoin tells you everything about its risk profile. If you understand how an issuer makes its money, you understand the potential risks you're taking on by holding their token. Now, all this explosive growth, you didn't think the big banks would just sit back and watch, did you? Of course not. The traditional banking world is preparing its response, and it could change the future of digital money entirely. And that response is something called a tokenized deposit. Think about it this way. Instead of a crypto company creating a token that's backed by money, this is a traditional bank taking the actual money you have in your account with them and just representing it directly on a blockchain. So the absolute key difference is that with a tokenized deposit, you hold a direct claim on the bank's own balance sheet. It's not a new thing representing your dollar. In the eyes of the law, it is your dollar, just in a new, more high-tech form. And this comparison makes that distinction crystal clear. A stablecoin is a claim on the issuer's pile of assets. A tokenized deposit is a direct claim on the bank. Stablecoins are typically uninsured. Tokenized deposits would be covered by existing banking laws, potentially even deposit insurance. What you're really watching is a battle between a new financial world and the old one finally adapting to new technology. So that leaves us with this huge, fascinating question. On one side, you have these incredibly profitable stablecoin issuers who built a whole new financial system from the ground up. And now, the giants of traditional banking are stepping into the same arena with their own, more regulated model. So who's going to win? Which model will dominate the future of digital finance? That's not just a crypto question, it's a question about the very future of money itself.